Introduction. Here we are. Tax and Jobs Act signed December 22nd by the President. It's the largest tax reform in 3 decades and will affect pretty much everybody one way or another. It is a big one, but it's hastily written. It's unclear. There's a lot of details to be figured out. I actually feel sorry for the IRS because they have to figure it out. I've been to 3 workshops for CPAs. No, I do, because I know some of them. But I've been to 3 different professional all-day workshops, and they had 3 different interpretations for some of the biggest parts of this, like equity interest, like the 20% deduction. So, and I'll try to explain as I go that some of this we just don't know yet. We've got a good idea what they're trying to do. Most of the individual provisions are for 5 years. The corporates are permanent. And my interpretation of this, they really knew what they want to do for corporate America. They want to lower the tax so they'd spend more money, bring more money in. The individual is kind of a hodgepodge. They give this, they take this. It's more political than anything else, which makes it frustrating and complex. Big thing to remember, California has not conformed, nor have other states. So right now, the federal tax system, California is a lot different from each other. California doesn't like a lot of it. They're trying to come up with some creative ways to kind of stick it to the federal government, like calling state tax a donation. So then you could write it off your federal tax, So interesting stuff, but a lot more to come. I'm going to kind of follow the tax return. So if you remember the 1040, you start with income, then you have adjustments, then you have itemized deductions, then you have credits, then you have tax. There's no real change on income. All the income that was income is still income. But adjustments, there's a couple of little adjustments in here. And I know I'm going to tell you more than the real estate stuff, but I'm going to focus on the real estate stuff. I think it's important. Some of these might come up one way or another. But again, moving deduction, currently through 2017, if you have a work-related move, and it's over 50 miles, you could deduct a cost for transporting you and your goods to your new home. That's suspended, that's gone. Those cross-country moves will be hurt. Alimony, currently, if you pay alimony, it's deductible. If you receive alimony, it's taxable. Starting after 2018, those new agreements, it won't be. It won't be deductible or taxable. So why they did that, I don't know, but they did. Standard deduction, that's what you take if you don't have enough itemized deductions. A lot of publicity here that it was doubled. Don't get too excited because it's more than washed out by exemptions going down to 0. But here it is. See, 2017 here for married jointly was $12,000. Now it's $24,000. Single was $6,300. Now $12,000. So that was those low income taxpayers who don't itemize saying, here's a big help here. But again, it's kind of washed out later, which I'll show you. Itemized deductions. One nice thing they did, currently, if you make too much income, like over $400,000 if you're married, you don't get all your itemized deduction. They phase out it up to 15% of it. So you could lose up to 15% of your itemized deductions. That's gone now. So whatever your itemized deductions are, you get them all, no matter your income. So that's a good thing. Medical expense, they lowered the threshold to 7.5%. For this year and next year, it used to be, then it'll go up to 10%. Not a biggie, but a change in trying to do something good. Here's a big one for California. Currently, we're able to deduct all the California and other state tax you pay, plus your property tax. We're talking about personal residence or second home. We're able to group those all together, combine with other taxes like DMV fees, if you have a boat tax, and we deduct the whole amount. Now they're limiting that total pot to $10,000. So if you're paying a lot of state tax or a lot of property tax, you really get a big haircut here. So, I have clients that pay $50,000 of combined. Now they lose $40,000 in deductions.
Isn't this the biggest complaint that
Californians
have?
It is. Yeah, and it's rightfully so. It really affects us. Some states, don't have state tax.
Right, but the higher state tax.
Yeah. We lose that. So exactly. Here's another big one, somewhat real estate related. Equity debt is suspended. Currently, you could have $100,000 of equity debt and use it for anything and write off the interest. You could use it to student loans, to finance college. You could use it to buy a car. You can consolidate debt. You could take a trip around the world. You still get to write interest on that $100,000. That's gone. No grandfather provision either. So old equity debt, no longer write off that interest. There's uncertainty on equity debt to use for acquisition or improvement of your home. Currently, of course, you could write it off. One workshop says no. One newsletter says yes. We're not quite sure. If I had to guess, it'll be a yes. But that's where, they take an equity debt to do a remodel. Can they write off that interest or not? We're not sure. But if they use it to fund education, for sure you can't write it off. So, so here's a big one. The acquisition debt, the mortgage interest. Currently, we're not talking about rentals. Rentals are pretty much the same. Investment property, pretty much the same. But residences or combined 2 personal homes. Currently, you could write up interest up to $1 million on loans, plus $100,000 equity debt. That's going down to $750,000. So $250,000 less. So those large mortgages, they're not going to be able to write off the interest above $750,000.
That's for a couple.
Yeah, exactly. And single. That's single too, but married separate is lower.
Okay, so are we grandfathered if we already own our house?
Way to lead me in. Boom. Existing debt is grandfathered in. So I'm going to use this $900,000 example in a second. So if you have a $900,000 mortgage right now, and you incurred before December 22nd, 2017, yes, you continue to write off that interest. So that's good. But if you sell that house and buy another one and get a $900,000, no, you're limited to $750,000. But the one you have, Wow. You guys read my thing. Refinance. So back to that $900,000 loan. Say in 2018, you refinance it for $900,000. Yes, you could still write off the interest on the $900,000. If you took out more, no. If you took $950,000, you don't get to write off on the $50,000. Even the costs of the loan to refinance, if you build those into the loan, you can't write off the interest on that part. So if it costs you $7,000 that you added to the loan, can't write interest on that. But the majority, yes, you can. Then one more thing, weird on refinances. So if I go back to that set $900,000 loan, let's say it was a 30-year loan and you've been paying it on for 5 years, so there's 25 years left, and you refinance in 2018, you could only write off the interest on a $900,000 for 25 years, the original term that was left. And then it gets reduced for that last 5 years because that's kind of a new loan in a sense. So it's going to be a nightmare tracking all that and allocating all that, but that's it. But the good news, most refinances will be fine. But again, the big thing is it used to be $1 million, now it's $750,000.
Were they almost going to go to 500 on that? Is that
Yeah. They were talking going real low. And then I've heard something, banks are getting real creative. Like they're saying, okay, we're going to do a let's say there's $1 million mortgage. Okay, we're going to split it into two. $750,000 we'll charge like 6%. And then we'll charge real low on the $250,000, and kind of stick it to the IRS that way. So I don't know if that will go through. Personal casualty losses. That could be a house burning down, flooding. That could be somebody breaking in your car and insurance doesn't pay at all. Any of that. Used to be able to deduct it. Now you can't. It's for personal, you can't. Business, you can. If you have gain because the insurance company paid you more than it's worth, they tax that, but they don't let you write off a loss. Unless you're in a federal disaster area, then you're still able to do it. So like Santa Rosa, yeah. No, it's like I said, a hodgepodge of stuff. Miscellaneous itemized deduction will affect some people quite a bit. That's on Schedule A at the bottom, where we write off like tax preparation fees, investment fees, and work-related expense. If you're an employee and you're a salesman, you get a W-2 and you have a lot of unreimbursed expense. You write off your mileage, you write off your meals, you write off your entertainment. That's completely gone. So, some taxpayers, that's going to hit pretty hard. Independent contractors, not affected directly by that. But the employees will be. So hopefully the employers will start reimbursing the expenses would be a way to get around that. Personal exemptions. Big one. Currently, you're able to deduct $4,050 for you, your spouse, and dependent kids or other dependents. Now down to zero. So that pretty well offsets that standard deduction increase pretty quickly. New tax rates and brackets. We're going to have a handout that really shows this better. But I'm just going to focus over here. This is 2017. And this is for married joint. 0 to 18,000 of taxable income. In 2017, it's taxed at 10. 2018, 10. But then you start going down and you see 2018 is pretty much lower everyone. They lowered the tax brackets. That is one big thing that got a lot of publicity. There's only one band between 400 and 417 that's taxed 35%, 2018, 33 and 17. Why that's higher, I don't know, but then it goes lower again. So point is they lowered the tax brackets. Here's those exemptions. 2017 used to be 4,000, now nothing. Capital gains. There's a lot of talk. Were they going to do something with capital gains? Lower the rates, extend the holding period, up the rates. They did nothing. Capital gains are still get favorable treatment. That's long-term capital gains. If you held a property, in your case, real estate for over a year, stocks, what have you, kind of, if you don't know, or you need to be reminded, or you don't care, I'm still going to say it. Currently, so married filing jointly, if your taxable income is $77,000 or less and you have long-term capital gains, the tax rate is 0. You don't pay any tax on that. Between $77,000 and $479,000, you pay 15% federal capital gains. Over $479,000, you pay 20%. And that's quite a bit less at that bracket. 35% ordinary income, so to give you a 15% benefit for selling this investment type property. So AMT tax, I spend hours every year trying to explain AMT tax, alternative minimum tax, to myself and clients. It's and a lot of people are in it. It's a system to make sure high income earners pay quite a bit. There's a lot of thought that, wow, they're gonna get rid of it. They got rid of it for corporations, but not for us. Still there, but I think a lot less people will be subject to AMT. One is a bad reason, because a lot of the things that put people in AMT, like on AMT, you have to add back personal exemptions. You still have to do that, but they're 0. So you don't add much back. Taxes, you were able to, had to add back state and property taxes. Now that's only 10,000. So big difference. Equity debt interest, miscellaneous itemized deduction, that salesman expense. So that's going to help a lot of people not be in AMT, but it's not really an advantage. But they did increase the amount not subject to AMT substantially. So we plan to see a lot less clients subject to AMT. Who will pay AMT? The people with incentive stock options. The techies. There's less incentive stock options out there. There's more RSUs, more non-qualified options, but they did something on it. Kiddie tax, just go real quick on that. Used to be you have a young kid who has too much earned income. They have to pay tax at your highest bracket. Now they have their own table, a tax bracket. Child tax credit, big one. Juliet, probably wish this was here when all your kids were small.
I'll have more kids.
Yeah. They increased it. This is a credit. So this is dollar for dollar off your taxes. Plus $1,400 per kid could be refunded. They increased it from $1,000 to $2,000. And they significantly upped the amount before they're phased out, which I'll show you in a second. They do have to have a Social Security number. So here's a little table. 2017, 2018. Went from 1,000 to 2,000. The amount refundable, I think there's Ted Cruz who held out for this. He wanted 1,400 refundable, went up from 1,000. The big one here, those credits used to be phased out with taxable income at 110 for a married couple. Now it's up to 400. So a lot more people with dependent kids 17 or under are going to get big credits there.
Can you just explain that a little bit?
Yeah. Mm-hmm.
What's the 110 and 400?
Yeah. So what happened? Yeah. That's taxable income. Yeah. So used to be like if you had $200,000 of income, you got no credit. It got phased out. Now you'll have full credit up to 400. Then it starts to get phased out. So.
And this is per kid.
Yeah. Mm-hmm. Education stuff. They left most of it alone, which I'll show you a little bit, the credits, the deductions, student loan, but they expanded 529s. Currently, you can only use it for higher education after high school. Now you can use them for private school, elementary, high school. So a little bit there. The Obama mandate, starting 2009, no longer required to have health insurance. IRS was in charge of collecting the penalties if you didn't have health insurance. So that's going to be gone. Again, not 2018, but 2019. That'll make our work easy. Entertainment, big one, self-employed people. Currently, you're able to deduct 50% of entertainment. That's like taking people to sporting events, golf shows, plays, what have you. Completely zero now. So you cannot deduct that. Meals look like they're going to remain at 50%, but some resources are saying, no, they meant to bring those down to 0 too. So it's something to look at there. She's not happy. Hey, goose again. No, just kidding. No. It used to be if you do in-house cafeteria, you could write off 100% of the meals. Now that's down to 50. So again, just a lot of give and take. This one doesn't apply to most of you, probably, but if it does, it's biggie. This is related to depreciation. If you have a rental and you buy the rental, or you improve the rental, or you have a business here and you buy computers, what have you. Section 179 is how much you could write off in the first year of qualified property. Not of a house, but tangible property. They've doubled that. So you could write off now $1 million in the first year. You don't have to write it off over 15 years, 7 years, what have you. Again, trying to encourage capital expenditure by business. So biggie. The thing I think is bigger is they expanded the qualifying property. And if you went down here like non-residential, this isn't residential rentals, but commercial rentals. Like here, if you put a roof on it now, you used to have to depreciate that over 39 years. Now you could write it all off in 1 year. So again, clients who have those commercial properties and going to make improvements, this is big. Other people, nah, I'm going to go quick here. Basically, they upped how much you could write off on a car a year. There's limits on passenger vehicles. Basically, you could write $10,000 off, regular depreciation, $8,000 bonus, so you get to write $18,000 off. That's quite a bit more now. Again, trying to encourage capital expenditures. Like kind of exchange, real estate. There's a lot of talk about this too. The 1031s, the Starkers. Are they going to make it harder? Are they going to take it away? What are they going to do? The good news for real estate, they left it alone. They're still there. If you identify the property in 45 days, you don't touch the money, you close within 180 days, you're good. Still there. They took it away for personal property, which is interesting because what it's going to affect is cars. If you're a business owner and currently if you trade in a car, you don't pay tax on the gain of that trade-in because you're kind of deferring it into the new car. Now you're not able to do that. You have to pay tax on that trade-in. So this is something to be aware of, that it's not just automatic deferral. You don't need that one. Okay, here's probably one of the biggest part of it, not going to affect all of you, might affect clients. And it's the most unclear right now, the Section 199A deduction. So for qualified business income, which I'll get to, which is the pass-through entity. You might have heard that, the flow-through entity, which could be a sole proprietorship, be an LLC, it could be an S-corp, it could be a partnership, it could be a rental. Those are all pass-through entities. If they have income and you don't make too much money, now you get a 20% deduction off your taxable income. So, just as simple, if I had a business and I made $100,000 net, say my taxable income was $150,000, I get to have a $20,000 deduction, 20% of $100,000 profit. If my taxable income happened to be 80, then I get 20% at 80 or 16,000. But it's this new deduction for businesses, for rental properties. Little suspicious that Trump has so much real estate income, but it will help tremendously, for those rentals that have profit. It's going to get more confusing, and I'll probably try not to confuse you more. Qualified business income. It's trade or business. I think it's easier to see what doesn't qualify. Investment. Capital gains are not qualified business income. Interest, dividends are not qualified business income. Compensation you get from the business is not it. So you get a W-2 from your S Corp. That's not part of it. That you don't get 20% on that. You get 20% on leftover profit. If you're a partner and you get guaranteed payments, that doesn't count. There's uncertainty if all rentals will qualify. It looks like they will, but some interpretations say no, maybe not. Not vacation rentals, but other rentals will. But it's a big deduction. And again, if you use that $100,000 thing, a 20% deduction and a 40% tax bracket, that's significant. If you have a loss if I had a business, that same business, and I lost $20,000, I carry that loss forward to offset profit in the next year, so I don't get 20% on the whole profit the next year. And that just makes sense. One thing that does make sense. It reduces taxable income, not adjusted gross income. It doesn't reduce self-employment tax, just the income tax. And again, a biggie. There are phase-outs and penalties if you're a service business. The phase-outs start, and again, all my warnings here, because I'm just going to go down here. What happens, the little guy's protected. So the good news, if your taxable income for a married joint is $315,000 or $157,000 if you're single, no restrictions. Whether you're a service business or whatever, you're going to get a 20% deduction. If you're over that, then you have to start looking at other factors. You have to actually pay wages from that business. It could be to you or somebody else. So this might be the time you switch entities. If you're an LLC, which doesn't pay wages, you might convert to an S Corp. So you are paying wages. So you're able to go to this other formula here, which I think I'm going to ignore, but anybody want to know it, I'll tell you after. Because I think most of you would say, shut up, in a sense. But yeah.
The question, just to make sure, so
Yeah.
when you say deduction, are you saying, is that a deduction in your adjusted gross income
Off.
or off the tax amount? Yep.
Oh, it's in between, neither. So it's a deduction, not a credit, off your taxable income. Yeah. So it comes off your taxable. So yeah, hence that $100,000 example, I get a $20,000 deduction. Yeah, exactly. So if you're in a 30% tax bracket, yeah, it saves you, $6,000 or so. But still significant. And when you get the big boys, who are making millions, and they're not a service business. Now, service businesses, you still get up to $315,000, but then it's phased out to $415,000, and after $415,000, you get none. Include financial advising, accounting, real estate, basically personal service stuff, athletes. $315,000 or lower, you get it all. Between $315,000, $415,000, married joint, you get some. Still unclear. They did exclude architects and engineers from service businesses. We're not happy about it, but the whole thought was they are helping build something where we're not. We're just selling something or selling our services. So kind of interesting. So again, what's clear, anybody with taxable income, 157 single, 315 married, will get a new 20% deduction. Anybody over 415 or 207 and your service business, you'll get none. So, yeah. Corporate, home stretch here. Sorry. Again, they took care of the corporations. The rate is now 21% flat rate. Used to go up to 35%. Check for them. The AMT tax, alternative minimum tax, repealed permanently. Good for them. So again, they're happy. Estates and trusts, you might run into this a bit. Currently, when you pass away, if you pass away, you $5.6 million goes to your heirs tax-free. You know, that's the estate tax exemption. Over that, there's a significant tax. They've doubled that starting 2018. So now it's $11.2 million per person. So a couple will have $22 million that could go to the heirs tax-free. So a big jump. They were talking about making it just go away altogether. The gift tax or the annual exclusion now is $14,000 that you could give to individuals, and they don't have to. Nobody has to file gift tax return. Now it's $15,000. There's a table for kiddies and trust. Don't really need that. So again, home stretch. Here's some things that didn't change. Some of these will affect, or you might have thought would change, didn't change. They talked about it. So I'm just going to point out a couple. Maybe. There we go. So big one for you guys, the sale principal resident gain exclusion at $250,000 per person, $500,000 couple. Yeah, if you live in your house 2 out of 5 years before you sell it, it's your primary residence, you get $500 tax-free or $250. That's still there. Interesting one, they were talking about making private activity bonds, where that's where a city issues bonds to build a stadium, to make that not tax-free anymore. They left that alone so the Raiders now could build that Vegas stadium, because that was in doubt, because it would affect the interest rates they'd have to pay. A little bit more, the retirement plans, they were talking about reducing the 401k contribution to IRAs. They left them alone, so they're alone. Some more stuff. The education stuff they left. All the credits, all the deductions, all the student loan interest. Most of the energy stuff, the solar's there for another couple years. Big one, the plug-in electric, that $7,500 credit for Teslas, still there. These are the corporation ones that are still there. I don't think we need to go over that. Again, they're happy. Hence why, yeah, they're bringing money over. They're paying more, but now that's making the stock market go down because we're afraid of inflation and interest rates and the whole bit. So it's a weird thing. This little chart is here. You guys want it? It's a great little chart. It gives all the 2018 brackets. It gives the capital gain brackets. It gives the exemptions. It gives the education credits. It gives the standard deductions on the back. It gives the IRA limits, the deduction to 401k, Social Security, what the limit is, how it's taxed, health savings account deductions. Those are up here. And that is it. You know, even though it's so big, there's not that many parts to it. You know, at least from our point of view, Kevin and I, well, we look at it and say, God, this thing was supposed to be terrible, but there's not that many parts, but there is that planning thing mainly for businesses. Hey, how can we get that 20%?